Institute of Risk Management, India affiliate presents Elevating Operational Risk Management in India's Banking Sector.
Pursuit of business growth is important, but it should never come at the expense of taking unacceptable risks. This was a statement made by the Reserve Bank of India Governor, Mr. Shaktikanta Das, reinforcing the idea that robust risk mitigation is essential for ensuring the long-term success and resilience of both a regulated entity and the overall financial system. Now, operational risk, a critical component of risk management, has become more significant as financial institutions expand their operations and adopt new technologies. The regulator's focus on this area with a series of mandates highlights the need for banks and NBFCs to strengthen their risk controls, especially in the face of evolving threats such as artificial intelligence, climate change, geopolitical conflicts, third-party dependencies, and even supply chain disruptions. Now, the compounding challenge is also the difficulty in quantifying these risks. Unlike a high-risk loan, which can lead to specific measurable financial loss within the lending function, issues like a damaging customer service mishap can have far-reaching effects, impacting revenue streams across the organization for years to come. With this in mind, here's welcoming you all to today's panel discussion on elevating operational risk management in India's banking sector by the Institute of Risk Management, India affiliate. As the world's leading certifying body in enterprise risk management exams across 140 countries, the What's the Risk initiative underscores our unwavering commitment to driving thought leadership in every sector and discipline. Joining me in the fourth episode today are Amit Talgeri, Group Chief Risk Officer, Axis Bank; Sanchita Mustafi, Chief Risk Officer, Aditya Birla Capital; Ashwini Kumar Chaudhary, Group Chief Risk Officer, Union Bank of India; and Subhash Narayanan, Managing Director and Chief Risk Officer, DBS Bank India Limited. Amit, let's start the conversation with you. Why don't you talk about operational resilience and the entire evolution of operational risk management in India, especially with the role of RBI?
Operational risk involves, in failure of internal practices around systems, processes, technology, and also people, also external events. Prior to 2001, there were no specific, areas of risk around operations risk which were kind of identified. It's only in 2001 when the Basel Committee on Banking Supervision actually identified operations risk as a core and a critical area of risk separately. And then subsequently there have been multiple areas where operations risk has got further policized in a sense. In 2004, Basel II introduced for the first time elements around operations risk capital that banks needed to keep. There were multiple parameters that were introduced, basic indicator approach to the advanced approaches, etc. And then of course in the post 2008 global financial crisis, while the entire focus was on credit risk and market risk, there were elements of operations risk which also were kind of put together in terms of strengthening the entire operations risk framework. Subsequently, in multiple years, there have also been evolution in terms of simplifying, standardizing, and more importantly, integrating it with operations risk. In 2021, there were papers around operations resilience. And if I were to kind of fast forward to see in the Indian context, the regulator has also been, implementing some of these regulations as a part of our day-to-day banking and financial services institutions operations. What's also happened is that over a period of time, there have been multiple areas of operations risk that have come to the fore, specifically around vendor, customer. We've seen outsourcing come as a big one, and then of course there's cyber. If I were to kind of really look at each of those specifically, there is the whole area around customer complaints, mis-selling. With increasing digitization and the advent of adoption of internet and mobile banking, technology and system downtime has become key areas of what we call operations risk. And finally, with the multiple areas of outsourcing that we are doing, outsourcing risk has also become a very key indicator in terms of operations risk.
We've been successful in tackling the pandemic, even lessons from the 2008-9 financial crisis. But going forward, I think the level of preparedness needs to be enhanced across the financial sector. So what are some of the unknowns that you think banks and NBFCs both need to be prepared for?
Digital risk is becoming a very, very big element. Today, we've seen the advent of sheer volume of transactions which are coming through the banking system. Transaction monitoring, digital frauds is one big area related to operations risk. The second is, the upcoming data privacy laws. You could see a big change in terms of the way data is, stored, protected, and more importantly, used. And finally, there is cyber risk. Clearly that's the unknown. There is a lot that we can do as a part of cyber risk, but there will always be elements that, where we need to kind of reinforce our perimeter.
Sanchita, building on what Amit said, based on your experience, how do you think NBFCs are evolving on the entire operational risk management framework, looking at third-party business continuities, disaster recovery?
The whole digital framework of the bank and NBFCs have grown significantly, which has led to increase in the operational risk. So it is important that we review our operational risk framework, and our regulator has also come up with the regulatory guidelines regarding operational risk framework and resilience framework. Now, if you look at it, there have been identified 3 pillars. Pillar 1 is about adopt and implement, and pillar 2 is about resilience, and pillar 3 is about learnings. Now, if you look at pillar 1, it's purely about change management, it's about roles and responsibility of senior management, it's about how a risk management framework of operational risk management framework to be there. But pillar 2 talks about significantly about how cyber risk framework. It talks about vulnerability assessment, penetration testing, so as to ensure that there is no gap and there is no threat in between which could be vulnerable to any incident happening. Then it talks about bringing in interconnection between BCP and DR such that all the cyber risk incidents are built up into the planning of the BCP and DR, and a DR playbook has to be ready, and DR playbook should identify when it's to be called a DR threat, and then DR testing incident, and then we need to have a detailed RPO and RTO being defined, and which should be looking into the gaps which are there in case of any testing, and if there is any gap at the time of testing, how to go back and check those gaps and mitigate those gaps, and the RC around that. So it is important that we need to look into the cyber risk policy and the resilience framework that vendor has, and how strong is their cyber risk posture. And we need to continuously monitor it and review it and put a framework around it, model around it, so that we are identifying the categories of vendor accordingly, the materiality, the importance into our line of business also. So there is a significant programs which are, we need to be developed around the system, and also we need to see how we are able to bring the changes into the system and bring adaptability into the system through RCAs and learnings which could be derived out of the BCP, DR, cyber risk framework, the different vulnerability testing, etc.
Ashwini, you're representing the public sector on today's panel. Are you seeing any specific operational risks for public sector banks? And since most of the public sector banks come with legacy systems, how are you implementing operational risk management across the organization?
For different products and processes, we have something fully automated, something partially automated, something even manual. So the managing entire change process is a big task for the bank. At every point in time, there will be some change with respect to adoption of new processes, automation of some processes, moving from manual to automation. And during this process, you need to manage the entire activity properly. You need to ensure that there is no disruption in the activity which is going on. Plus, whatever change management you are adopting, those are very smooth. You have done proper back testing, you have applied all the logics. So it does not create any problem once you have gone for automation. So you need to invest a lot of time into review of people, processes and systems, because unless you review the entire product and processes, you will not be able to identify the risk associated with this. So this is a continuous journey, and at all point in time, we need to keep on reviewing these processes and adopt changes. And with the legacy system, a lot of issues also comes up. For example, there will be issues with respect to dormant account, inactive account.
Right.
How do you operationalize those accounts? What are the processes we are going to follow? Because these are more vulnerable to any fraud. number of inoperative accounts will be there in the system. How do you use them? How do you ensure that any vulnerability can be mitigated while operating these accounts? So managing all these things become very important.
So what are some of the measures then you're taking to make sure that operational risk management is successful in a public sector ecosystem?
Yeah, we are making investment into digitization of the processes. Number of processes are getting automated. So that's a big task, and we are also at the same time trying to centralize some of the activities which reduces the risk which comes from decentralization of activity or manual process. We are making investment in training and grooming people, our own people. That's a continuous journey. We have created that system of.
And I'm sure that's also part of the overall risk culture building.
Yeah, we are spreading risk culture. We are ensuring communication across amongst various verticals of assurance functions, along with various business units. So continuous communication, messaging from the top. Through this, we are trying to spread risk awareness, risk culture. That is definitely helping us.
Okay. And finally, Subhash, turning to you, the Institute of Operational Risk, which is now part of the IRM, has always released several guides around OR governance, OR resilience, risk control, self-testing, and there are many other international standards and frameworks. So coming from a multinational bank, what is your recommendation in terms of international frameworks and standards that India's banking sector should look at?
To me, what is important is when you are operating across countries, how do you make sure the bank is able to achieve the level of risk culture, level of operational resilience which can work for you, right? So that is where I think the international framework comes in. Interestingly, if you look at what has come out in the recent RBI circular about operational resilience, people used to talk about operational risk, now the resilience has come in, and this is the same trend we are seeing in terms of HKMA circulars or MAS circulars. So there is a coming convergence of all other regulators in terms of their approach. What the international frameworks then also gives you is the experience people have had in dealing with some of these risks, right? Some market may be ahead in certain implementation. I would say India is probably way ahead of some of the other markets in terms of fintech. What are the challenges we face from a digital fraud? I'm sure other markets can learn from us. But then how do you share that without disclosing from a confidentiality, data secrecy perspective? And that's where some of the organizations like IRM comes in, where they can give guidance in terms of how these risks have been looked at, what can be done. To me, one other important benefit of these frameworks is that each organization has its own risk appetite threshold, right? This will help you benchmark to see where you are and in line with your internal organization threshold, decide what level of controls you want to put. I mean, that's, to me, it's a very important one in terms of customer service, balancing your profits, balancing your risks, right? So it's in life, it's never easy, but how do you make sure you get the right mix? And that varies from bank to bank.
Yeah.
And that's where some of these governance frameworks, the ideas give you how you want to benchmark.
All right, we're going to take a short break, but we'll be right back with this esteemed panel to explore the geopolitical challenges, risk related to financial inclusion and fintech, and the role of ESG in operational risk management. Be right back.
Institute of Risk Management, India affiliate presents Elevating Operational Risk Management in India's Banking Sector. Institute of Risk Management, India affiliate presents Elevating Operational Risk Management in India's Banking Sector.
Welcome back to the 4th episode of IRM India's What's the Risk initiative, Elevating Operational Risk Management in India's Banking Sector. I've been in conversation with Amit, Sanchita, Ashwini and Subhash. Sanchita, let me get your thoughts on the compliance landscape in India. With the recent actions by the Reserve Bank of India, what do you think NBFCs and lending platforms should do to ensure higher consistency with the regulations?
So Harsh, it is important that we start bringing compliance function into our risk appetite statement also and have KRIs around that. The first and foremost thing is a chief credit compliance officer plays a very significant role in putting up the Compliance framework in an organization. The senior management and the board is equally responsible to put up a no tolerance towards any irregularity in the compliance in letter and spirit. Now, what is compliance risk? Compliance risk is a legal and regulatory risk which is arising, or no financial risk or a risk towards the reputation of a bank or an NBFC, which would be arising out of any irregularity in the law, in the guidelines, in the policies. So, it is important that we bring the chief compliance officer into change management processes, and it should be part of the review process for any new process that is going to be added or new change in the product line that we are going to bring in. It is also important that we bring complete independence to the compliance function so that he can start reporting any kind of discrepancies or any kind of error which has been found into the compliance framework to the board and the senior management equally. And it is hence important that we bring in the policies of compliance risk, related policies approved by the senior most authority at the board level.
And see, compliance ultimately is linked to people and culture.
Yeah.
So how do we ensure that risk management ownership actually permeates to the lowest level in the bank or NBFC?
So it is tone at the top. And as I said, zero tolerance towards any of the irregularity in the compliance framework to be, read in and managed by the senior management and the spirit and in letter also. And it is hence important that we bring the training and development of the first line of defense specifically into understanding of the culture of compliance.
Subhash, India has actually maintained a commendable degree of stability amidst the current global economic challenges, and that's all credit to the regulator and also all you chief risk officers for standing as champions of resilience. How are you seeing the impact of global geopolitical risks on multinational banks like yours, and what is it that you are doing to ensure that these risks are well factored into your risk register or risk culture?
One of the key things we look out for, I don't think it's specifically, I'll put it into the cross-border type of bucket, but it's more in terms of how do you manage the risk, how do you manage the disruption. What we look for from a operational risk perspective when we do the assessment from a third party outsourcing risk is continuity in terms of service, right? So any disruptions which happens, how do you mitigate the disruptions? How do you manage an alternate service in a disruption, right? So one recent example is the Windows default, so many airlines were not able to function. If that kind of scenario happens to you, how do you make sure you have an alternate service provider you can switch to, right? One of the things we have started looking at from a disruption perspective is if you are doing service with a specific vendor, do you have an exit strategy, right? If you are unhappy with them, how do you exit, and is there somebody else providing that service?
Yeah.
It could happen that sometimes the vendor who is providing you the service, there is no immediate alternate service available. Could be a software service provider. Then would you have access to a source code, right? Or that's the biggest thing on all of this is, again goes back to my earlier statement in terms of risk threshold. The best way to avoid this disruptions will be to put redundancy. But how much of redundancy can you have? Because the more redundancy, more the cost.
Ashwini, the government's push on financial inclusion and fintech, I think the public sector bank has a huge role to play. What are some of the risks that you see in this space, and how should public sector banks really mitigate them?
Initiatives such as Jan Dhan, Aadhaar, mobile and internet banking, UPI, all these things have helped the country in achieving financial inclusion. And banks have played very important role in achieving that financial inclusion. To achieve this objective, what banks are doing, because we may not have presence at every location and we may not have that kind of resources, so there will be outsourcing of activities which is done through banking correspondent partners. So when we engage with BCs, then you need to ensure that whatever activities they are undertaking, that is in line with bank's expectation. So supervising overall activity of BC, banking channel partners, becomes very critical for the bank, because ultimately we are responsible not only for financial losses but also for reputational damages, if any. Hence, selection of right partners, doing proper due diligence of those partners before onboarding, defining processes for hiring of people by them, what kind of activities they are undertaking, are they mis-selling, what kind of control you are putting. So overall monitoring and supervision of their activity becomes very critical for us. And as a bank, we must do this very properly and take care of all the risks.
Amit, finally coming to you, how are you seeing the integration of environmental, social and governance risks, and is it in line with the regulatory expectations?
Yeah, so first and foremost, it has become a very, very important part. It is part of boardroom conversations now. We do have, for example, board level ESG committees which are discussing risks, not just operations risk, but all kinds of risks related to ESG. COVID was a prime example of how ESG was at play there. Climate events, external events, caused havoc with business continuity, business operations, and like Ashwini mentioned, having a strong and robust BCP, business continuity plans was a very, very important element of managing that whole event plus operations risk. Climate risk is a reality. We are seeing more and more climate events now. Business continuity at different points of time in different parts of the country, and the risk teams in most organizations are at the forefront, emergency response teams, to see how we can kind of manage some of these events. You look at floods, for example, the recent floods in Andhra or Gujarat, for example, the entire BCP is in progress there. There are DR drills which become very, very essential, that you can probably have operations, continuous operations without disrupting, customer flows there. And most importantly, what's the risk around that? There is the hazard heat maps, for example, which look at physical transition risks. Yes, delinquency is one parameter, but there are a whole host of events which are causing us to look at vulnerable areas, vulnerable geographies, where you could have portfolios which could probably tomorrow attract a different set of capital or provisions, etc. So there's a whole host of that which is now coming in as a part of this whole operations risk and resilience, which is part of that whole ESG risk management, which, like I said, is now an integral part of boardroom conversations in terms of managing risk.
But on that note, thank you panelists for sharing your invaluable insights and expertise, which have really enriched our discussion on elevating operational risk management. I think the ability of India's banks and NBFCs to adopt a comprehensive approach to risk management, one that goes beyond traditional metrics and even addresses the full spectrum of operational and non-traditional risks, is crucial for ensuring long-term resilience and stability, as they said. And a key takeaway from today's discussion is that in an increasingly interconnected global landscape, collaboration is going to be extremely crucial. Banks and NBFCs will need to work together to develop and implement innovative risk response strategies that not only protect stakeholders but also empower the entire financial system, making risk management a cornerstone of business strategy. Thank you, and stay tuned for our next episode of What's the Risk?
Institute of Risk Management India Affiliate presents Elevating Operational Risk Management in India's Banking Sector.